Hello dear students, today we will discuss a few of the important terminologies related to banking, or to give you a better understanding, the instruments that the Reserve Bank of India uses to control inflation. See, it is, as we all know, it is the primary job of the RBI to maintain inflation rates within a country. Now, how does RBI go through the process of controlling inflation rates? So, essentially, what is an inflated economy? An inflated economy is an economy in which there is a lot of cash, there is a lot of money with the public. Therefore, when something is in excess, we all know the value of the commodity reduces. Now, why is gold so much valuable in our day-to-day life? It is because there is only a fixed amount of gold present on this earth, and it is very rare. So, therefore, rarity is what increases the value of a substance. In the same sense, if the currency is rare, if there is less amount of money circulating, the value of the money will increase. That is a situation which we call as deflated economy. In an inflated economy, there is a lot of cash present within the public of the country. Now, how does RBI control the amount of money that is left with the public? There are various instruments. First, we will see the CRR. Full form is Cash Reserve Ratio. Now, what is this Cash Reserve Ratio? This CRR is an essential tool used by the RBI to regulate banks. I told you banks are a bit risky in nature because they tend to give away loans to certain subprime customers who are not having the potential to repay the loans. In search of profits, bank make this mistake a lot of time by giving away excessive loans to garner more profit. So, to control that aspect of banks, we have cash reserve ratio. That is the ratio is mentioned by the RBI. Now, what is this cash reserve ratio? Say, for example, this is a bank, and we have customers depositing money in a bank. Let's say the gross total value that the bank has now is 100 rupees. Now, what do you expect the bank to do right now? The bank will use this money to give away loans to various customers and recollect that loan and gain a profit. So, to make sure that entire 100 rupees is not given away as loan. See, what happens if the entire 100 rupees is given away for the loans? Next day, a customer might come to the bank and ask for his money. He has the right, they have the right to withdraw money from the bank. But since the bank has given away all the 100 rupees, the bank will be left in a state of bankruptcy. Bankruptcy means the bank is not able to repay its customers. So, to avoid this, RBI uses a cash reserve ratio. The rate is determined by the RBI. For our example, let us take 10%. See, if the cash reserve ratio mentioned by the RBI is 10%, then 10% of 100 should be given to the RBI. That is, 10 rupees should be deposited with the RBI. The bank cannot use this money, neither can it hold the money with itself in the bank. The bank has to reduce this 10 rupees, leaving the total amount as 90 rupees. And this 10 rupees or 10% of the total amount that they have with themselves is given to the RBI for safekeeping. It is a reserve. This money is the money of the bank, but it is being reserved in the RBI. It is kept by the RBI to make sure that the banks do not default. Now, this 90 rupees the bank will lend and make out a profit. Now the next is SLR, also called as statutory liquidity ratio. Don't be worried about the term. It is a simple concept similar to that of a CRR. There is a bank, let's say they have 100 rupees in total. Okay, the same example. Now the RBI will mention the rate for SLR. Say, let's assume that the SLR rate is also 10%. Now this is SLR is completely different from CRR. The bank first should deposit CRR with the Reserve Bank. The remaining amount is liable for SLR. Now SLR, that is, according to this percentage, it will be 10 rupees. Now this 10 rupees need not to be submitted to the RBI. This 10 rupees is left with the bank itself, but in the form of liquid in a state of liquidity. That means not in watery state. It means either in the form of cash or gold. See, the cash has the highest liquidity. Next to it comes to the gold, comes next in line to the level of liquidity. Now what is liquidity? Liquidity essentially means the ability of the money to exchange hands. When money is in cash form, it is highly liquid. That means you can easily give away your notes to the shopkeeper and buy the commodity. Now next most liquid is gold. When you have certain amount of gold with you, you can always deposit gold and take currency, exchange gold for currency, because there is always a demand for gold. But it is not true with real pieces of land, other commodities such as cars, etc. These do have value, but they are not liquid. You will not be able to sell your land quickly. You cannot exchange your land for the commodities, whereas cash and gold are easily exchangeable. So this 10 rupees has to be kept with the bank itself in the form of cash or gold. It means the bank is liquid. Now the rest 90 rupees can be given out as loans. Now why, even though there is CRR, the capital reserve ratio, why does RBI use SLR? Why does the RBI require the banks to keep certain amount of money as in a liquid state? It is because customers can approach the bank. It is the right of the customer to approach the bank and withdraw cash. So therefore cash and gold must be always kept within a bank, so as to facilitate the consumers. So this is about statutory liquidity ratio. Now next is the famous repo rate. See, we have banks and we have the central bank, which is called RBI. Now each bank is say X, Y and Z. These are different banks and there is an RBI. Most of the times, since most of the money of the banks is been sent out as loans, the banks do not have enough money for their daily day-to-day transactions. That is why the banks tend to borrow money from RBI. These banks will borrow money from the Reserve Bank of India. Now the rate at which the banks borrow from RBI is called repo rate. That means essentially RBI gives out loans to individual banks at an interest rate. That interest rate we call it as repo rate. Now CRR, SLR and repo rate. These are essential functions that the instruments that the RBI use to control inflation in the economy. Let's say, example, the economy is in a highly inflated state. That means the population is having a lot of money in hand. So if there is a situation of inflation, the RBI will increase the CRR rate. Say it was 10%, they will make it 20%. By increasing the cash reserve ratio, we see that only 80 rupees is left with the bank to give out as loans. Therefore, it reduces the lending capacity of the bank, thereby controlling the flow or influx of money within the economy. Now, in the similar way, SLR, which is 10%, can also be increased by the Reserve Bank so that the money is left with the bank itself and it does not go through the process of lending. If there is an increase in SLR, for simple understanding, if there is an increase in SLR rate, the inflation in the economy will reduce. The next, repo rate is the most powerful weapon of the RBI to control inflation. In simply put, banks will be borrowing from the RBI. If you increase the rate, before it was 10%, banks were happily borrowing a lot of money from RBI, giving it out as loans and making a profit. Now, in this mechanism, the flow of money was directed into the economy where the amount of cash in the economy was increasing gradually. But when the RBI increases the rate, the repo rate, it means that loans for the banks will become costly. It will become difficult for the banks to borrow from RBI because after borrowing, they should also pay the interest. If the interest is greater, it will not be economically viable for the bank. Therefore, banks will stop borrowing from the RBI. When banks stop borrowing from the RBI, it means that they are lacking the capacity to give out loans. Now, why do banks borrow from the RBI? It is essentially because they need to give out loans to garner a profit. Now, since the rate has become costly, the interest rate has increased, therefore, banks will refrain from borrowing via the RBI. Therefore, it will cause a reduction in the lending ability. Since banks will stop lending money, the amount of money going into the market will reduce and the inflation will come under control. So these are the few examples in which RBI manages inflation. The government of India is also responsible for managing inflation. It has various other instruments which we will be studying in the next class. Thank you.